I want to dissect a recent trade that went very poorly, talk about the defensive mechanics behind it, and the resolution of that trade. We, of course, could do an anatomy of a winning trade from Frank. We'd have less examples to work with, but I could find one if you give me a long enough look back period. But it's not fun to do that, right? Like Frank bought the thing moved higher, he made money. There's no anatomy. I bought it, it moved higher, I sold it. Losing trades are far more interesting. Everybody remembers, their biggest losing trades, and it's way easier to manage a winning trade than it is a losing trade. So I want to get into what I think is a pretty prime example of an options trade, like a pretty standard setup that you could really attribute to almost any options trade, show you what happened, show you what I did, and show you how this thing was resolved. And I'm looking at a short straddle that I put on June 6th at the money straddle, the 159 strike in SFX. SFX, if you don't know, is the small US dollar futures, has been actually a really nice product for the small exchange for those of you out there looking for US dollar exposure against a basket of euro, yen, pound, Canadian dollar, Mexican peso, Australian dollar, and a bunch of other markets in there. But don't worry about that. It's just an example market. The market was on June 6th at 159. And I sold the 159 call and put, or the at the money straddle, for $2. And so my break even is $2 on either side here. And all the stuff that we're talking about can be attributable to strangles, even iron condors. If you're the type of person who wants to defend an iron condor and say the market moves above my call spread strike, and I want to, just get short that market and defend it there, you can really apply what we're talking about today to a lot of different option strategies, and long option strategies, not so much. There's honestly just not so many defensive mechanics you can do with option strategies. If I bought a straddle and the market didn't move, then my idea would be, oh, well, I need to just buy the next expiration of straddle. And maybe we'll get into that at some point, but really prime example here, market's at 159. I sell the 159 call and put on June 6th. I bring in about $2. And so I'm chilling as long as this market between June 6th and expiration is within $2 of 159. Then I'm profitable and I don't have to worry about anything. And that didn't happen. June 14th, market rallies all the way above 163, blows out my upside break even by a full $2. And I'm out $200 per contract, which may not seem like a lot, but given that this SFX market is a smaller price market, margins just about, I think, 170, 180 in capital requirements, a $200 loss per contract was big. And this coincided with highs in the US dollar that we haven't seen in years. So big price extreme. I'm hurting. I'm feeling tense. This market's at a high. What am I going to do? And I'm not just going to sit on this and hope for the market, hoping not a good defensive mechanic, hope that it comes back down to 159. What I am going to do is I'm going to move around some things, but I'm not going to get too fancy with this. So since I'm short that straddle, and in theory, my upside break even is 161, I can convert everything that I have, essentially a worthless short put. I should probably just buy that back, get it off my books, get rid of that risk. If the market did reverse and just like fall all the way down to 155, now I'm long. I don't want that. Buy back the worthless put, and I convert that in the money short call. Say when the market's all the way up at 163, my short 159 call probably has like 80 deltas to it. I'm basically short the future. So I'll just get rid of all the options there, and I'll take on a short future that I pretty much have from 161. And the market still is at, 163 or wherever it was trading around mid-June. What I'm also going to do is I'm going to sell the at the money put. And what I mean by at the money is where my short future is situated around. And so this would be the 161 put. So the market's at 163. I'm short a futures contract basically from 161, and maybe I can sell that at the money put for 75 cents or $1. And so now I'm short the 161 future. I want that market to go lower. I'm short the 161 put, and I got that for, let's say, 75 cents. My new break even is now close to 162. And so already I'm kind of mitigating some of my losses there. I'm bringing in more credit by being active. And then, of course, I still need the market to fall off of those highs. And what's nice about starting with a short options trade is this market moved up to an extreme high price that it hasn't been to in years. Yeah, I want to be short. And so don't get super mixed up. I know people like going inverted with different things, and that totally works. But don't, sell a strangle or a straddle. The market moves to an upside extreme and then somehow turn yourself around and get long. I still want to be net short that market. Same with, I sell a strangle and the market falls down to all-time lows. I don't want to turn myself around and end up being short that market. So I still have short deltas in this scenario. I still want the market to fall. And since I have the short future and the short put, the market can fall all the way down to zero, and I'm getting back to profits in here because I've got the static short future. I really like when you have short in the money options in the futures world. I really like to convert that to the underlying futures contract because the margin's pretty much the same, and I'm not going to get whipsawed if the market reverses. June 16th, the market reverses and falls below 161, and I'm able to take this position off for a scratch or even a slight profit if I timed it well on June 16th, because US dollars really came off there just a couple of days after those all-time highs. So here is the anatomy of a very simple options trade that I was losing on, didn't freak out, didn't get myself all turned around, didn't just sit there and wait for hoping for something to happen, because if the market hangs at 163 or moves a little bit higher, it really behooves you to a little bit of action, bring in a bigger credit by doing what we did and defending against that market moving on higher. But yeah, the last thing you want to do is completely turn yourself around and go from leaning short to leaning long. The market comes back and you don't know which way you want the market. Very simple strategy for dealing with a losing options trade, with a nice example of the small US dollar options, SFX, nice and small, easy to get started in there if you want to try out trading options and options on futures today. But that's it, friends. I am getting out of here. I will be back tomorrow for Friday's edition of Small Stakes. You're going to want to hang around, though, for Splash into Futures coming up next. I'm sure it will be fantastic. Continue looking at those interest rates, everybody. That's been a wild and fun market. But have a great night. Peace.